Yeah, hello everybody. After a long interruption, I have again some time to speak to you about now cases illustrating how the credit method is practiced, at least in the German law. So, to give you an opportunity to check if your understanding of how the method works is correct or not. So let's begin with the case data. Mr. A from Aachen in Germany has the following income this year. Income from a job at Kleve, 60,000. And second bullet point, income from a house in the foreign country of Faroestan, a country where we have no double taxation treaty. And so where no special rules are available, only the general rules of the German Income Tax Act deal with that matter. Now, the income tax paid over there in Faroestan on the rent from the house is 8,000. Deductible personal allowances, so special expenses and extraordinary expenses accepted under German law, shall be 10,000 euro. That's the case. And naturally, the question is plain and simple. How much will be the income tax which is payable in Germany by A for this year? Now, this year shall be 2022. Now, how do we deal with cases where we have to apply the credit method? That's the question. The first step will be plain and simple. Solve the case just regularly as if the credit method does not exist. The only thing which you do is when you check the events, just ask yourself if the credit method will be applicable or if instead only a deduction as business expense can be possible. If the credit method is not allowed, deduct the foreign tax as business expense here. If it is allowed, do nothing at this. Now, second step, calculate the tax as always completely regularly. So that means apply the tax tariff of the current year to the complete worldwide income. The only peculiarity, which you do not yet know, by the way, is if there have been tax-free items, then do not forget to apply the so-called proviso safeguarding progression when you have to determine the tax rate. That's something which you learn later. Now, deduct the tax credit from the tax. There is, however, an upper limit for the credit which can be granted. That is the German tax, which is levied for that part of the income in question. Now, how can you calculate that German tax? It's different according to the tax character. Income tax, average income tax rate times the foreign income in question. Corporation tax is a different calculation. That's the whole secret. So, step one, regular solving of the case. Step two, application of the tax rate. Step three, deduction of the tax credit after calculating the limit, and then it's all finished. Congratulations. Now, here is our case again, and so let's begin at the beginning, as we always do. The first thing is the personal tax liability. We have A as a natural person, so the ESDG applies. So the Income Tax Act. That's simple. A is owner, or A lives in Aachen, in Germany, so has residence in Germany, and so we have unlimited tax liability. You remember that is nothing else than the fact of being liable to German tax with the whole worldwide income. Now let's go to checking the events. Here we have 2.1, the income from the job at Kleve. This is income from employment under the German Tax Act that can be found in paragraph 19, section 1, number 1 of the ESCG. So that's a part of the worldwide income. Paragraph 2.1, number 4 says that all income from employment is taxable income. The tax base is the surplus of revenue over expense here. That can be found in paragraph 2 to number 1, no, number 2, ESTG, sorry, that came from. And that's given here as 60,000 euros, so that's no problem where we should investigate more deeply. 2.2, the house in Fargo-Wayston. The first question we have to pose is if that is a part of the taxable income. You remember there are 7 types of income under German law which form the worldwide income. This is here income from lease and rent activities, and we can prove that by section 121 or paragraph 21, section 1, number 1 of the Income Tax Act of Germany. And so it's a part of the relevant worldwide income. That is according to the list of the 7 types of income in 2.1 number 6. The tax base is the surplus of revenue obtained minus expense. 2.2 number 2 ESTG, no big fair, here given as 20,000. Now the question is the foreign tax deductible as income related expense? So that's the case if the deduction method has to be applied or must be applied. Or will it be disregarded here and later credited to the tax liability? So let's simply check if the credit method will be applied under the rules of paragraph 34c, section 1 ESTG. And for this we would have to, we have to have a look into that rule. So if we do that, then we find out we need an unlimited tax liability taxpayer. Yes, that's fulfilled. We need foreign income. Well, now you think that a house in Fargo-Wayston is automatically foreign income, but naturally, as this is a question here where we have to decide about the treatment of a huge amount of money for the taxpayer, there need to be a legal definition. And so we have to look that up according to 34D number, and there is a list 7, I believe. That would be foreign income. So, and you saw just now, I'm not absolutely sure. And so what do we do here if we are not sure? Yes, certainly, we look it up. And indeed, here we have the foreign income defined. Let's start with it. Income from agriculture and forestry, if it's from a foreign state, income from business where you have a permanent establishment in a foreign state, income from self-employment. Well, that's not our case. Income from the alienation, so from the sale of fixed assets of a firm if the assets are located in a foreign state. Shares in limited companies if the company is from a foreign state. Income from dependent work exercised in foreign states. Income from capital if the debtor has residence, place of management, or so on in a foreign state. And now number 7, income from lease and rent, as far as the immovable property or the multitude of things which is rented out is situated in a foreign state. That's our case here. So yes, we have here an activity where the income qualifies as sufficiently foreign to be no longer qualified and seen as German income, so the tax credit method can be applied. Then, after we have found out that, we have to clear if the foreign tax is an income tax, and this, yes, because case say so. If it has been assessed by the foreign authorities, paid, and there is no refund claim possible, has never been possible, yes, that is to be assumed here, because that's the normal situation. So the result is the credit method can be applied, and that means the deduction is not used, and that means the foreign income from lease and rent remains unchanged, 27 euro. So now third step, adding it all up to the total taxable income. We have from event number 1 job income 60,000. We have from event number 2 the house income, lease and rent, plus 20,000. Then we have the deductible personal allowances, that is minus 10,000. So we have a total taxable income of 70,000. That's simple. And so now we have to make step number 2 and calculate the regular tax for that. So here you see the German tax tariff, which is valid for the income tax period 2022. And we see in the fourth bracket that for an income of 70,000, that is between 58,000 and some other amount of money up to 277,000, the formula applies 0.42 times all the income. So 42% of all the income minus a correcting factor, which takes into account the fact that the first parts of the income are taxed not fully at 42%. And so if we apply that formula, we end up with the correct tax burden for 70,000. So let's do this. So number 3, continued, just means 70,000 times 42% minus the correcting factor of 92,067.53. And here we now need a calculator, which helps us a bit. 70,000 times 42% is 29,400. And now if we deduct that correcting factor, then we end up with a total of 20,132.74. Now 47, sorry. That is to be rounded down to 4 even euros. So this is the final tax. That corresponds to an average tax rate of, well, the average tax rate is the percentage which you pay for all your income. So that divided by 70,000 ends up 28.7606% or 0.67%. Let's not debate so complicated things. And now the fourth step, or in our graphics in the small doodle video at the beginning, that would still be step 3. Now deduct the tax credit for the foreign tax paid in Far-Awaystan. The first thing we need to keep in mind is the credit granted is limited to that amount which Germany claims for the foreign income. So Germany levies here 28.7606% on 20,000 foreign income. That is a German tax of 5,752.13. Now paid in Far-Awaystan has been 8,000. So creditable is only an amount there of 5,752, because that is the limit for the credit, so the maximum credit, because that is the maximum credit here. So Germany credits the foreign tax, but it does not more than reducing its own tax claim for these items to 0. So remaining German tax liability for this case is, what did we have first? 20,132 minus credit 5,752, and there a result comes out. And naturally, let's take refuge to our calculators. And surprise, it is 14,380 euro, which has to be paid by our taxpayer A from Aachen to the German Fisc this year. Case finished and completely solved. So what shall we do now, ladies and gentlemen? Well, what comes after the first case? That's not a surprise. Probably there will be a second case, and exactly that is what is going to come. So let's have a look to a second case now. Okay, which surprises will this case bring? This is now DGmbH, a German corporation with seat and place of management in the small city of Bedburg in Germany. And DGmbH had in the year which has just finished, and we again assume this is the year of 2022, the following income. First, it was income from a business, a shop in Bedburg, 200,000 euro. And the second was an income from abroad. It was income from a piece of land in the foreign city of Mosbul. That's somewhere near Moscow, and at least it's somewhere on the globe. So 50,000, and assume with the country where Mosbul is situated, we have no double taxation treaty. That is, by the way, one of the reasons why I take often refuge to fictitious countries. That's the only way to reasonably assume there is no double taxation treaty. And the tax paid there already on this income was 5,000 euro. So the decisive question now is, what comes out in the end, and donations made to charity deductible from the total tax base are 50,000 euro. That's a bit of a hard, yeah, a hard hit. Okay, so let's think about it and then try to solve that case. So here is now the case again, and we can try to solve it. First is again the step concerning the personal tax liability. We see DGmbH, sorry, that was a typing mistake. DGmbH is a juridical person. So under German law, it's clear that the KSTG applies the corporation tax law. DGmbH has seat in Germany, so the register's office. So unlimited tax liability is given under paragraph 1, section 1, number 1 of the KSTG. So the worldwide income is subject to tax. You can either write that or regard it as self-evident. If you write it, no harm is done. So checking the events. Well, the income under KSTG has to be determined according to the rules of the ESTG plus KSTG. That can be found in the paragraph 7.1, 7.2 and 8.1 of the KSTG, and all income they have is deemed to be income from business, but by the way, for foreign income treatment that plays no role whatsoever. That's in 8.2 KSTG. Now, so everything they earn is taxable. So event 1, no, let's call it the event. We already said that. So 2.1, the shop at Bedbrook How, 200,000 is taxable. 2.2, the piece of land in Mossbull is also taxable with 50,000. So we have a subtotal of 250,000. And now the donations are a bit tricky because we ask ourselves now questions, how is that treated or so? And does the credit method bring some turmoils here? But now you should remember the basic trick. When the credit method is to be applied, then we should completely first ignore that and solve the case as regularly. But I have now assumed the credit method has to be applied, and here I have to add a step again. Check if the credit method has to be applied or only the deduction method is possible. So in that case, that's 26 KSTG, and this rule says apply paragraph 43C ESTG accordingly, apart from how the credit limit is to be calculated. So if the credit method can be applied, follows from 34C KSTG accordingly, so with the necessary modifications which result from the fact that we here have a corporation tax case. Do we have an unlimited tax liability? Yes, that's fulfilled, see above. Do we have a foreign income? Yes, foreign piece of land. Income is again 34D, number 7 ESTG. That's foreign enough to be no longer regarded as German sourced income. Do we have a foreign, now corporation tax? Yes, according case in data, that's fulfilled. Has it been assessed? Has it been paid? And is there no refund possible ever? Yes, has to be assumed. Otherwise, one would have to tell us this. So the credit method can be applied. So no deduction from the taxable income, but later credit granted on the tax liability. So really it remains a subtotal. Profit from land remains because the foreign tax is not deducted, 50,000. So indeed our subtotal was correct, 250,000. Donations can be deducted up to a limit of 20% of the total taxable income. That's here 20% of 250,000. That's a surprise, 50,000 euro. So that would be the limit for donations to charity. Paid have been, no, that's not nice, 50,000. So deducted can be 50,000. So taxable income is 200,000 euro. Number 3, the tax on that amount is 15% according to paragraph 23, section 1 KSTG. So the tax is 30,000 euro. And now, after we have that, the next step will be, that would have been the third step in our doodle video. We solved the case regularly. We checked in between if the credit method was applicable or if we have to take refuge to the deduction method. And now we have to apply the credit method. So to calculate how much can be granted as a tax credit here. So applying the credit method. The first thing we need to determine is determine the limit for the credit. That is the German tax, which relates to that foreign income. And now there we will have a surprise. Here the German law says that the credit limit shall be determined as the total amount of German corporation tax, that's 30,000, taken times the share which the foreign income, here 50,000, has in all income which was achieved all over the world, so before the deduction of the donations. That leads us here to a formula that 30,000 is taken times 1/5. And that leads us to a credit limit of 6,000. Okay, under that formula. Now we have to compare with paid were in the foreign country 5,000 euro. So we are lucky we can credit for this reason the whole amount of the foreign tax which was paid. And the result is resulting German corporation tax is 30,000 minus 5,000 is 25,000 euro, which remain to be paid in Germany in the case of DGmbH. So it seems to be clear what comes after a case with DGmbH, now a case with a certain person named C. This is Mrs. C now. She lives in Cologne in Germany, and the new aspect of this case is that now we do not only have income from one foreign country, but income from several foreign countries. So let's begin with her inland income from a job in Cologne, 30,000. Then she owns a house in country A, and the rent income from that house is 20,000. The income tax which has been paid there is 8,000. Then she has a share in a partnership which runs a factory in country B, that's 50,000, and the local tax paid there is 10%, which is 5,000. And in the end, she has income from interest from country C, and the local tax paid there is 4,000. Special expenses and so on, which are deductible, that's 10,000. And just to make things plain and simple, none of these countries, A, B, or C, has up to now any double taxation treaty with Germany, so only the unilateral rules laid down in German law apply to this case. So let's look for a solution. So here it is again, our solution. The personal tax liability is the beginning of the case. We have Mrs. C. She is a natural person. So the Income Tax Act, the ESTG, applies. And lives in Germany, so resident in Germany, so unlimited tax liability applies under 1.1 ESTG. That's okay. Now let's have a look to the events. Number one, the job in Cologne, that leads to income from employment. We see what income from employment is in paragraph 19, section 1, number 1 ESTG. Current salary from a job is income from employment. So it's part of the worldwide income definition laid down in paragraph 2.1, number 4 ESTG. The tax base is the surplus of the revenue which you obtain minus the income related expenses. That's paragraph 2 to number 2 of the ESTG, and the whole stuff is here given with 30,000. So we don't need to worry about how we have to calculate that and which expense can be accepted and which can be not accepted. The second thing is the house in country A. This is probably income from lease and rent, because the income seems to be from rent paid for that house. Other things, the interpretations will make no sense. So it's a part of the worldwide income. 2.1, that was number 6 ESTG. The tax base is again the surplus of revenue over expense. We have here the source for that, and this is given here as 20,000. Now we need to check the treatment of the foreign income tax. Is the credit method allowed? For this we need to check paragraph 34 C1 ESTG, and we have unlimited tax liability. Yes, that's fulfilled. We have foreign income, and we can remember, yes, lease and rent income from a foreign piece of land or a foreign immovable property, a foreign house, is foreign enough to be no longer considered as German-based income. So we can indeed qualify this as foreign income. Was it a foreign income tax instead of a foreign dog tax, property tax, inheritance tax, and so on? Yes, see the case data. And was it assessed while the foreign authorities paid and no refund claims were ever possible? Yes, is to be assumed when there is no other information available. So the conclusion is the credit method can be applied, and that means no deduction as income-related expense for the foreign tax. On the other hand, because later something far better will be made, the crediting. So the income remains unchanged, 27 euro. Okay. Now let's go to event number 3, the share in a partnership with a factory. Now a factory is income from business. Paragraph 15.2 ESTG says that, and that every shareholder or partner in a partnership has to pay taxes for his or her share is in 15.1 number 2 ESTG to be found. So it's a part of the worldwide income because it's one of the 7 types of income. 2221 number 2 ESTG. The tax base is here defined as the profit. So what is your part in the profit resulting from the tax balance sheet, which the foreign factory has to present, and that is here given as 50,000. Again, check if credit method can be applied. 34C1 ESTG, and there, ladies and gentlemen, their result will be unlimited tax liability, liabilities, liability, oh my god, liability, yes, that's fulfilled. Foreign income, that can be found in 34D, number 2, letter A. Yes, the factory is a permanent establishment abroad, and that is foreign under that rule. Foreign income tax, yes, case says so, and assessed, paid, no refund, yes, that can be assumed again. So the conclusion is credit method applies. So no deduction of the foreign income tax from the income, but later something far better. Okay. So the remaining amount of that income is income remains 50,000. Now we come to number 4, which is the income from interest. And here we need to be careful. Income from capital. Paragraph 21, number 7 is interest income. Income from capital is taxed separately from the worldwide income under current German law. So a German tax of 25% is levied on these 20,000. That is something which you can see at the moment in 32D1 of the ESTG. So we have 25% on 20,000, that is 5,000 euro. Again, test credit method. There is now a separate legal source for that, which contains nearly all the same rules, 32D5 ESTG, and it says after you check it, credit method is allowed. So what do we have? Let's add it all up. The total taxable income comprises only all the worldwide income without the income from capital. That's the peculiarity. So we have the job, 30,000. We have the house with 20,000. We have the partnership in the factory with 50,000. So we have a subtotal of, oh my god, 100,000 minus special expenses, so personal allowances for, let's say, old age insurance payments and so we have a total taxable income of only 90,000. Yeah. Now the tax for that, according to the tariff, has to be found out. And you remember that was a formula, 42% on everything, minus the deduction, which was in the current year, which applies here, 9267.53. And if that is still correct, then 90,000 times 42%, 30,800 minus that correcting factor. There we end up with 285347, and that, just to mark that for future generations, is a value which results from the formula applicable in the year of 2022. Now we can, just for information, compute the average tax rate which results from that. That's always a very useful thing when you have to do with foreign income. So divided by 90,000, that is a percentage of 31 to 7%. Okay, now we can turn to applying the credit method to that case. For one, we need the credit for the tax on the house in country A. We do it country by country. The credit limit for the income from country A is German average tax rate. So the tax which the taxpayer pays on that income times the foreign income, and that is here 31,727% times 20,000. This is 6,340.54 or so. Okay. Paid abroad was 8,000. So the limit for the credit is here the German tax. Creditable is only 6,340. So for two, the partnership share. We have credit limit for the tax on the partnership share. That is the German tax, so German average tax rate. Now on the foreign 50,000 from the partnership. So that 15,851 paid has been 5,000. So credited can be the full amount of tax paid abroad, 5,000. So, and for number 3, for the interest, well, German tax separately calculated is or was 5,000, paid were 4,000. So credited maybe the full 4,000. This again, ladies and gentlemen, leads us to the final conclusion: how much tax needs to be paid. Okay, so what do we have to pay the tax according to the tariff has been, let's look it up on the previous slide, that was 28, no, 28, 537. So that's it. Huh? By the way, without numbering. Now, minus credit for country A. And that credit was, let's look it up, 6340. So 6340 minus credit for country B. Okay, here again a typing mistake. You know I'm very generous with typing mistakes. I hope you get used to it. Here we have the full 5,000 for the partnership. That leads us to a final amount of tax, which is relatively simple. 28,532 minus 6,340 minus 5,000, that is 17,192 plus on top for the income from capital separately determined 5,000 minus 4,000, that is 1,000. So total amount of all income tax in Germany this year, so 2022, is 7,192 plus 1,000. Sorry, 1,000. That's it. Case finished and solved. Please remember the two basic things which you need to know in order to solve this case correctly. First, income from capital, that is interest income or income from dividends, is taxed separately from the worldwide income under current German rules, which are in place in 2022. And the other thing is, when you have income from several countries, you calculate the credit limit for each country separately and then compare with the tax which was paid in that individual country, country by country. Okay, so that was case C. Let's look what comes next. So here now, not a big surprise, DGmbH is now in play. And DGmbH has its seat and place of management in Germany. It has a permanent establishment in Germany, which brings a profit of 300,000. One in country A, which has a profit of 500,000 in country B. Another one with 200,000, and in country C, one with 600,000. So the taxes on income paid abroad were in country A 200,000, in country B 5,000, in country C 15,000, so rather low amounts. There is no double taxation treaty with any of the countries A, B, C, so no modification of the general rules. And the question is, how high is the final tax payment of DGmbH for the current year in Germany? So let's think about that and approach that case step by step. So let us now have a look to the treatment of this DGmbH case, and let's begin with the beginning, that is personal tax liability. That is simple because DGmbH is a juridical person, so the KSTG applies. The next aspect is its unlimited tax liability because the seat is in the German inland, 1 number 1 KSTG. After that, we turn to number 2, checking the events. Everything has to be determined as income according to the rules of ESTG and KSTG. That follows from rules which you can find in paragraph 7.1, 7.2, and 8.1 KSTG. And there is an additional rule that everything which DGmbH earns is automatically classified as income from business A2 KSTG. So everything it has is automatically a part of its worldwide income under 2.1 number 2 ESTG, because business income is one of the 7 types of income, and the tax base has to be computed as the profit, so to be determined by a tax balance sheet. Now, as everything is taxable income from business here, the total taxable income is just to be found by adding everything up. We have 1.6 million. The next check is now if the foreign taxes have to be classified as deductible expense deduction method, or if instead we can use the credit method so that there will be no deduction from the income. Let's check 34C ESTG. For this purpose, we have unlimited tax liability, yes. We have foreign incomes, yes. Foreign permanent establishments qualify as foreign for business income. 34D number 2 letter A says this is enough connected with foreign states to be no longer seen as sourced in Germany. Foreign taxes on income, yes. According to the case data, that was foreign corporation tax. Were all these taxes assessed, paid, and there were never any refund claims? Yes, that is the natural assumption here, because the case tells us nothing else. So the credit method can be used. No deduction as business expense can be claimed. So the total taxable income remains unchanged, and the taxes abroad will later be credited to the tax liability. The total tax is 15% corporation tax according to the tax rate, which is laid down in 23.1 KSTG. So we end up with 240,000, which are taxable, which are the tax. And now the credit method has to be applied country by country. And here you keep in mind that the credit limit rules are different when it comes to corporation tax. Here we take the whole corporation tax and then we just find out the percentage which country A income was of all the income worldwide. So 500,000 in relation to 1.6 million. That leads to a tax of 75,000 out of 204,000 which relate to country A. Paid in country A was 200,000, so creditable is only 75,000. Country B, again, the credit limit is all the corporation tax, 240,000, which is paid for the worldwide income, taken times the share of country B income, here 200,000, in all the income achieved worldwide, that 1.6 million. That leads us to a final result of 30,000. Paid in country B was only 5,000, so we can fully credit the country B tax of 5,000. If we go on, then country C, same principle. The total corporation tax for the worldwide income is 240,000. The share in the total income of country C is 600 in relation to 1.6. That's 90,000, which results paid was 15,000 only. Creditable is so 15,000 only. So the final corporation tax computation for DGmbH will be 240,000 is owed for the worldwide income according to the basic rules in Germany. And we can credit 75 from the liability. We can credit 5,000 for country B. We can credit 15,000 for country C. That leads to a final amount of 145,000 euro, and that is the final solution of our tax case. So that's it. Well, surprise again, after DGmbH we have a case now with EGmbH. And EGmbH has its seat and place of management in Germany again. It has one permanent establishment in Germany, which brings a profit of 300,000. It has one in country A, which has 500,000, one in country B with 200,000, and one in country C with 600,000. That seems to be pretty the same situation as before with D. Now the taxes on income paid abroad were 200,000, 5,000 at country C, 15,000, everything unchanged now. No double taxation treaties, no modification of the general rules. And now the decisive difference, DGmbH has a loss carry forward of 1 million euro from the last year. And you probably know a loss carry forward means that when you make losses in the last year, you can deduct these losses from the profit of this year so that you can recover the lost amounts free of tax. And you only pay taxes for the exceeding amounts. So that's the only difference to DGmbH situation. And sorry, here's now a printing mistake. The final tax payment for DGmbH for the current year in Germany. That has now to be determined. So here everything is probably as before. Let's have a look to the personal tax liability. Personal tax liability, that's DGmbH. Sorry, verbosity is a bad thing. Is a juridical person. So KSDG, and it's unlimited tax liability. And by the way, naturally this should not be numbered, so we correct this still. Okay, number one KSDG. And we have here everything the same as before. The events, well, the total taxable income for a corporation shall be determined according to the rules of ASDG and KSDG. You remember that. And the total income was 1.6 million euro. The credit method is applicable. Now I do something which you should never do in an exam, or so I just say that's the same as before. And now the decisive thing is again the total tax was 240,000. No, there's the difference, because now the total taxable income was 1.6 million minus loss carry forward of minus 1 million. So we have a total taxable income this year of 600,000. We have then 50% corporation tax on that according to 23.1 KSDG. That's only 90,000, ladies and gentlemen. And there now the difference comes into play. When of these credit limit calculation rules, because now let's look for applying the credit method. Country A, calculate the limit. Now we have 90,000 euro total corporation tax, which is payable in Germany. We have a share of 500,000 from country A, in total income from all over the world of still 1,600, because the loss carry forward does not lower the amount of money earned all over the world. So that times 90,000 leads to a tax of only 28,125. So paid abroad was again and still 200,000. Now creditable is only 28,125. Country B, let's calculate the limit for a credit for country B. We have 90,000 total tax paid for the whole worldwide income. 200,000 out of 1,600,000 can be credited. So 200 divided by 1,600 times 90, 1, 2, 3, 90,000. That's now 11,250. Paid was 5,000, so 5,000 can be credited. Country C, 90,000 is the total tax in Germany. We have now 600,000 out of 1,600,000, which can be credited, which refer to that country. This is 33,750. Paid was only 15,000, so 15,000 could be credited. And so we come to the final computation. We have a German tax of 90,000. Credited can now for country A only be 28,125. Then, so you see, one of the main effects of the loss carry forward has been not to save money for the German DGmbH, but they lowered the tax for the foreign income too. So what they effectively did is they just lowered the creditable amount. So a part of the German loss carry forward here ends up without having any tax saving effect. It just goes to the nirvana. So that luckily didn't happen for the other foreign countries, but that was sheer coincidence. Such an effect could also have happened with regard to these other countries. Yeah. So in the end we have 41,875, and so the credit mechanism, the credit method, has here now saved only a very, very small amount of money. We could instead think about applying the deduction method voluntarily, but that would not bring us very much, because we could then deduct 220,000 then we would have 1,600,000 minus loss carry forward 1 million minus deductible or minus taxes paid as business expenses, treated as business expenses. That would be 220,000, and then we would have a taxable income of 600 minus 220,000. That would be 380,000, and 15% on that would be 57,000. So the credit method is still better, although it saves a very low amount here in comparison to the case of DGmbH. But you see probably why the legislator here chose the way out to say we just do not look to the average tax rate, we look to the proportion of the foreign income in all income achieved all over the world, because that leads to a far lower tax saving effect for that firm. That is, from the idea of the fisc, a positive idea. Okay, let us now come to a last case for today. This is now Mr. F from Frankfurt, Maine. And F has income from the following sources: a job income from Frankfurt, 40,000. Income from a house in country A plus 30,000, and the income tax paid there was 5,000. Income from a share in a partnership in country A, that was a factory, 5,000. Income tax paid in country A for that was 10,000. The income from a farm in country B was 40,000, and the tax paid there was 15,000. And special expenses and so on of F amount to minus 20,000. The German tax of F, that's our question. And you see a difference here to the former cases was that here we have now two different income types from country A, So not every type of income comes from different countries, but several items come from the same country. And here the rule is that all the income from one country and all the tax from that country is taken into account together. Let's have a look. Okay, let us begin at the beginning. First, personal tax liability. This is F as a natural person, so ESTG applies. F lives in the German mainland, has a residence here, so unlimited tax, limited tax liability under income tax paragraph 1 ESTG. Okay, number 2, we check the events. 1, the job income is income from employment. That can be found out in paragraph 19, number 1 of the ESTG text. So it's a part of the worldwide income. Paragraph 2, number 4 ESTG. The tax base is the surplus of revenue over expenses, which are income related naturally, to number 2 ESTG, and that is here given as 47 plus. Number 2, income from a house in country A. That's income from lease and rent. Paragraph 21, number 1 confirms that. So we have then a part of the worldwide income, because 2.1 number 6 ESTG says this: the tax base is the surplus of revenue over expense, that is 2 number 2 ESTG, and that is here given as 30,000. Now, treatment of the foreign tax. Is it creditable credit method or only deduction method possible? To check is here, paragraph 34C 1 ESTG. We see we have an unlimited tax liability taxpayer, and the answer is yes, see above. We have foreign income. You remember under 34D, all that is regulated strictly. Number 7, yes, that was foreign income because there is a house situated abroad. Is it a foreign income tax? Sorry, and the answer is yes, according to the case data. Has it been assessed, properly paid, and without refund claims? So that never a refund claim existed, yes. So then the credit method can be used. No deduction as business expense or as better income related expense, because the German terminology says when there is no business, we don't call it a business expense, now we just call it an income related expense. Good. So the income here remains 30,000. Now event number 3, partnership in a that runs a business. So we have income from business, paragraph 15.2 plus 15.1 number 2. 15.2 ESTG says what is a business. 15.1 number 2 says each partner in the business has to pay taxes for his or her share. So that is now given as 50,000, and taxes can be credited. We have again to check for the 34.3 ESTG, and here we have similar entries as above. Is it foreign income? That is a bit different. 34D, number 2, letter A. Yes, because a foreign factory is a permanent establishment. A permanent establishment of an enterprise is every fixed establishment or every fixed place of business or every device which serves a business and is fixed. So a foreign factory is definitively a foreign establishment because there you have rooms and machines and so which remain at the same site continuously, so there you are permanently established, so that counts as foreign. The rest is the same, so credit method can be applied. It is applicable, no deduction from the income, but later from the income tax. And number 4, the farm in country B. That's income from agriculture and forestry, part of 13 ESTG. I do not know the details because nobody ever looks into part of 13 if he or she is not a specialized tax advisor for agricultural people. But it's a part of the worldwide income. The first one in the list of the types of income. By the way, here you can see from history when the list of the 7 types of income was made in the 1890s approximately, then agricultural income was still the main source of income for most of the population, so that was the first one in the list. Nevertheless, it's part of the worldwide income. The tax base is the profit, paragraph 2 to number 1 ESTG, given here as 40,000. That treatment of the foreign tax has to be determined, and so we have to check credit method allowed or not. To check this again, 34C ESTG. Let's spare ourselves to go on to all the details, but foreign income is something which we have to check again. 34D, number 1 ESTG. Agricultural income is foreign if the farming question is in a foreign country. So yes, all the rest of the requirements also yes. In an exam, naturally, you would have to go into details, even if you had written that before in another case. Yeah, so credit method can be applied. So no deduction from the income, but later. So now we have to go and look for the total income and compute the tax. So the total taxable income is now, in our case here, because of number 1, 40,000, because of number 2, 30,000, because of number 3, 50,000, because of number 4, 40,000. So we have a subtotal of 160,000 minus deductible expenses, special expenses, 20,000. So we end up with total taxable income 140,000. The tax is again 42% times 140,000 minus the correcting factor of 926753. That is the version of 2022. And let's calculate that. 58,800 minus 9,260.53. So 58,800 minus 9,267.53. I hope this is correct. 47. This can be rounded down to even euros, so that's our amount. It's also useful in income tax cases to compute the average tax rate, that is 94 divided by 140,000, so by the taxable income. And that's 35.3803%, or a bit more or less. Now, application of the credit method. Country A. All income from country A is 30,000 plus 50,000 is 80,000. Credit limit for income from country A, that's now 80,000 times 38.03%. That's 28,304.26. Paid in country A was 5,000 plus 10,000, that's 15,000, is fully creditable because below the limit. Now country B, we have credit limit, that's 40,000 times German tax rate of 35,308. So 41,3 times 38, no, 40,000 times 35, 38.03%. That's 14,152, rounded down. Paid there was 15,000. So creditable is only 14,152. And the final computation of the tax liability is now, we owe the German fisc 535. Credited as already paid abroad can be 15,000 in country A and 14,152 from country B. So we end up with 49,53 minus 15,123 minus 14,152. 20,380, so that's the final tax amount which remains to be paid in Germany. So again, this case has also been solved. So, ladies and gentlemen, up to now we have spoken about several cases where the credit method was applied. Now, in real life, people usually have income from several sources, and probably to some the credit method might apply, to others it might not apply, so that we have to take over or to take refuge to the deduction method. And so your task in more realistic cases would be to find out, is it a case for the deduction method or for the credit method? So that is a good motive to think about the next case here. And that would be Mr. G from Goch in Germany, who has the following income. Income from a job from the first 6 months of the year, 60,000. For 2 months, he had to exercise his job abroad in country A. For these 2 months, he earned 2/12 of his salary, that's 20,000, and was taxed abroad was 4,000. And income from house abroad in the country B, and income from an own business, which he started from July onwards, 120,000, In connection with that job, he had to stay abroad and worked for an order given by a customer there. Income tax demanded in country C was 40,000 and special expenses and so on are 20,000. So let's have a look how that can be solved. So let us start again with the beginning, which is usually a good idea. Personal tax liability. Liability. Okay. Mr. G is a natural person, so it's an ESTG case, income tax, not corporation tax. Unlimited tax liability because residence in the inland, that's Goch, Germany. That's 1/1 of the ESTG. Then we have the events. One is the job. That's income from employment. Paragraph 19(1), number 1. So it's a part of the worldwide income. Paragraph 2(1), number 4. Relevant tax base is the surplus of revenue over expense. Okay, number 2. And now we have foreign tax was paid. Do we have credit method available, or is deduction method necessary? In order to test that, we have to check 34C1 ESTG. We have an unlimited tax liability taxpayer. Yes. We have the question if there's foreign income, if the job income from the 2 months in question is foreign income. And well, let's have a look if that is indeed the case. So for our first event, we need to know if income from employment exercised abroad is sufficient to qualify as foreign income, irrespective of the time which you spend there. And so number 5. Income from dependent work which has been exercised in a foreign state or has been used without being exercised in the inland in a foreign state, and income which is paid by a public institution with regard to a present or former service, blah blah, and so on. What is definitively listed here is income from dependent work which has been exercised in a foreign state. Yes, our taxpayer has worked for 2 months in a foreign state, so if he had been taxed there, that is foreign income, and that tax would qualify then for the credit method. For this reason, we can say 34D, number 5, ESTG, yes, it's foreign income because it is income from employment exercised abroad. We have a foreign income tax. It has been assessed, paid, and no refund possibilities have ever existed. We say yes, so credit method is applicable, so no deduction. The income from employment therefore remains to be 60,000. Now we have number 2, the house abroad. That's income from lease and rent. Again, we assume naturally the house was not sold, otherwise that would have been mentioned. Paragraph 21(1), number 1 ESTG, part of the worldwide income under 2(1), number 6 ESTG, tax base is the surplus of revenue over expense for this type of income. Number 2, is here given as 47 euro. And again, the foreign tax credit or deduction method. Well, let us check paragraph 34C1 again. We have foreign income under paragraph 30D, number 7 ESTG, because immovable property located abroad in a foreign state. All the other requirements of paragraph 34C1 are also fulfilled. Income tax assessed, paid, no refund possibilities ever. So not in the future, not in the past. So credit method. That means no deduction from the income, and that means income remains 1,000. And then we have income from business activities. That's paragraph 15.2 plus paragraph 15.1 number 1 if he is a sole trader, which seems to be the case. It's a part of the worldwide income under paragraph 2.1 number 2 ESTG. Tax base is the profit to number 1 ESTG. Here given as 120,000. Treatment of the foreign tax credit method or deduction method. Now, what we have to look is, do we have foreign income from the order worked on abroad? We have to check paragraph 34D, and we are going to have a look on that. So we just had here the dependent work part of 34D. Now let's go back to the income from business. And here you see A, B, and C as the only activities which are acceptable from the perspective of German law as foreign income. Income from business can only be qualified as foreign if it comes from a permanent establishment abroad or a permanent representative acting for you in a foreign state, or anything else which comes down in the list here, if it's classified as income from business or reclassified into income from business. So if a German business fulfills a single order abroad without setting up a permanent establishment there, this will not qualify as foreign income from business. So it will still be regarded as a part of the profit of the German headquarter, although this profit has been made in contact with a foreign customer, but this is not sufficient to disregard it as a part of the German profit. The exceptions B and C don't come into play here. They are relatively rare, so we can say if there is not a permanent establishment abroad, the whole thing is not foreign income, but remains a part of the profit of the German headquarter of the firm. So it's a German profit. That means there will be no possibility to credit the tax. So 34D number 2 letter A does not apply. Why? Because only an order for a foreign customer, not a foreign permanent establishment. So it is regarded as German income, namely the part of the profit of the German headquarter of the firm. So no credit method applicable. That means deduction method is obligatory. 34C, paragraph 3, ESDG. So what follows from that is that the result of event 3 changes from 120,000 to 120,000 minus 40,000 deductible foreign tax to 80,000 income only. Yeah. Now, adding it all up. And by the way, naturally, this should not have a numbering, so we change that. Adding it all up means because of number 1, job income, we have 60,000. Because of number 2, we have the house income, lease and rent, 40,000. And because of number 3, we have business income, 80,000. Then we have minus special expenses. That's minus 20,000. And so all in all, we have a total taxable income of 160,000 euro. The tax for that under the rules of 2022 are again 42% on everything minus the usual correcting factor, which is here 67.53. That leads us to a final tax of 160,000 times 42% would be 67,700. 9,267.53. That is 5,793, and that can be rounded down. Now the average tax rate is always interesting to compute. That would be 160,000 again. So that would be 36,27,7, of course, rounded 7,8. And yeah, then we could go to applying the credit method. Credit for income from job in country A. We have a foreign income of 20,000 euro. So because he worked there only for an amount of 20,000. The credit limit is the German tax on that 20,000 in case of income tax to be determined by the formula average tax rate taken times 20,000 here. So 7,000, sorry, typing mistake, 4,156. Paid abroad was 4,000, so foreign tax can be fully credited 4,000. Then we have B, the credit for the house income from country B. The credit limit is again 36,20. 27,8 times, this was no 40,000, and here we end up with the German relevant tax of 14,483. Paid abroad was 10,000. So again, full credit is possible for all the 10,000. So we have the following final computation of the remaining German tax liability. That was all in all 57,932 minus credit for country A, that was 4,000, minus credit for country B, that was 10,000. So we have a credit of 14,000, and it is not a big surprise that this is the figure which remains to be paid still in Germany. End of case and complete happiness. Now this shows the similar situation in case of a GmbH. DGmbH is a construction firm in Hanover, Germany, and during the current year, which finished just now, DGmbH had income from the following activities. They had a building site in country A, which lasted for 10 months, 500,000. The tax paid in country A was 200,000. Then they had an income from a building site in country B, 3 months, 200,000. Local income tax paid was 100,000. And they had income from a building site in country C, 4 months, 40,000. Local tax paid. You should know now for solving that case that a building site is regarded under German law only as a permanent establishment in cases where it lasts for more than 6 months. If not, then it's just a single order. So that is the case situation. Let's think about a possible solution. So the beginning is simple as always. We have to go with the personal tax liability. We have a GmbH, so it's a juridical person, so KSTG applies. We have unlimited tax liability because the seat of the GmbH is in Germany. That is number one KSTG. The events have to be questioned now, and well, income is determined according to the rules of the ESDG plus KSTG special rules. That is paragraph 7.1, 7.2, and 8.1 of the KSTG. All income is income from business. Paragraph 8.2 KSTG. In case of a GmbH, that always applies. The income is thus part of the worldwide income under paragraph 2.1, number 2 ESDG, and the tax base is the profit, C2 to number 1 ESDG. And well, now we have to look to all the events. So building site in country A, that was 500,000. That's income from business. Foreign tax, how to be treated? Well, credit method possible. So is credit method allowed or deduction method necessary? Check for this purpose 40C1 ESDG. And the most important question will be, is the income from building site A foreign income? And the answer is yes, this is the case, because the building site A had been a permanent establishment due to the fact that it lasted for more than 6 months. If you want to look that up in paragraph 12 of the Abgabenordnung, the German General Tax Code, called AO by the usual abbreviation, that will confirm that. So the credit method can be applied. That means no deduction of the foreign tax from the income, because later we have a far better alternative. We can deduct it from the tax liability. So income remains 500,000 here. Number two, the building site B is not a foreign permanent establishment because less than 6 months. See again, paragraph 12. By the way, it's number 8 in the 8.0. So no foreign income under paragraph 30D, number 2, letter A. It's not from a permanent establishment abroad. And none of the other numbers there fits. So no credit method applicable. So deduction method is obligatory. 30C3 ESTG in combination with the paragraph 26 of the KSTG, and that says income changes from 200,000 to 200,000 minus the foreign tax, now as a business expense, of 100,000. So it's 100,000 only. Number 3, the building site C, the same is true. No income from a foreign PE permanent establishment, so no foreign income under 34D ESTG, because it's still regarded as the income of the German headquarter, although in contact with the foreign customer. So deduction, no. So credit method, not allowed. So deduction method is obligatory. 34C3. And deduction method means now you deduct the foreign tax from the income. So that's 30,000 then. Let's add it all up. We have income of 500,000 from country A plus 100,000 from country B, or referring to country B, plus 30,000. So we have 630,000 euro. The tax is 15% on that. Paragraph 23, 1 KSTG. That means we have, let me take a short look on my calculator. We have 94,500 euro German tax. Now, application of the credit method for country A. The credit limit is, now we have a corporation tax case, so we have a different formula. According to the formula, all German corp tax, that is 94,500, multiplied by the share of the relevant foreign income in relation to all income. So all income here, ladies and gentlemen, is, well, let's change the slide a bit. All income, no numbering, income is 630,000. Income country A was 500,000, so the ratio 500,000 by 630,000, that is 97.365% or so, and the share in the tax is 500, 630 times 94,500, and that is 75,000. So 75,000 is the credit limit. Paid abroad was 200,000. So creditable is 75,000. So final German tax is 94,500 minus 75. That's 19,500 euro. So that's it. Case all over and solved. Now there may be another complication which might come into play. The application of the credit method in German law, and usually also in foreign countries, requires that a tax can only be credited if it has been levied by that state from which the income originates, where the income was earned. So if income is earned in Faroestan, only tax levied by Faroestan can be credited. Taxes levied on the Faroestan income by other states, for example, because you have a second residence somewhere else or so that a second state apart from Germany taxes your worldwide income. These taxes, which were levied by other states than Faroestan, cannot be credited. Such taxes can only then be deducted. So the most relevant constellation where that can become relevant is if a taxpayer has two residencies, because if you have a second home in Holidayistan, Holidayistan levies an income tax on your worldwide income. So Faroestan will also be included in the tax base in Holidayistan. Yeah. So the tax levied by Faroestan on the Faroestan income can be credited, and the Holidayistan tax cannot be credited but only be deducted, because it is not a tax from the country where your income had its origin. So if we also know that, then let's have a look to the next case here. Taxpayer E from Ingolstadt in Germany has a residence in Ingolstadt and also a residence in the second country in a sunny beach in sunny Beachia. He has income from a job in Germany, 50,000, and the tax levied by sunny Beachia on that income is 5,000. And he has a house which was let to tenants in Faroestan, 40,000. Faroestan levied a tax of 12,000 and that money, and the tax levied by sunny Beachia on the same income was 3,000. Special expenses of our taxpayer is 10,000. So that is our case, and we have to try to solve this case now. Now, if we look to that case, then let's begin. The first thing is naturally the personal tax liability. Here we have that I is a natural person, so ESTG applies. And that person is also subject to unlimited tax liability, naturally under 1.1 ESTG because residing in Germany. Now let's go to the events. We have a job in Germany, 50,000 income from that job. Our income from employment, we can find this out by paragraph 19.1, number 1 ESTG. So as it is income from employment, it is automatically covered by the 7 types of income, and so a part of the worldwide income to 1 number 4. The tax base which we have to determine for that type of income is the revenue over expense. That's clear. The only thing we have to question is the treatment of the foreign tax credit method allowed or only deduction method possible. The credit method requires that foreign income has been taxed by a foreign state. Now a job exercised in Germany is not foreign under the perspective of 34D, so only the deduction method remains. So it's mandatory under 34C3. So we need to deduct the foreign tax here from the income. So the income was given with 50,000. After the deduction of that foreign tax, it ends up as 45,000. Event number 2, we have the house in Faroestan. That's income from lease and rent. We can find that out by paragraph 21, number 1 ESTG. So it's a part of the worldwide income because it's one of the 7 types of income. So we need to compute a tax base, and the tax base for this type of income is surplus of revenue over expense. Here it's given with 40,000. We have now to check the treatment of the taxes. The treatment of the Faroestan tax. The question is credit method allowed or only deduction method possible. 34C ESTG has to be checked. The income is foreign income because it originates in Faroestan. The tax was levied by Faroestan itself, not by a third state, so all other requirements are also fulfilled. The credit method is possible, so we have no deduction from the income to be made here. So now we have the treatments of the Sanibicia tax. The income here is foreign, but the tax in question was not levied by that foreign state from which the income comes, so we have no fulfillment of 34C1 ESTG. So we have the deduction method mandatory, so the income changes from 40,000 to 37,000. So we have now, when we add it all up, 45,000, 37,000 is 82,000 minus the deductible personal allowances, 10,000. So we end up with 72,000 in total. And now we have to compute the income tax for that and apply the credit method. So for 72,000, the formula under the tax tariff is again times 42% minus the correcting factor. So that leads us to 72,000 times 42%, 30,240 minus the correcting factor for the fact that the first slices of the income are taxed at a lower level. So 30 minus 9267.53, that is 9. That's 20,972 euro. That leads to an average tax rate of, in relation to that, and that is an average tax rate of 29,12843%. And so we can now think about the credit method application. The credit method can only be applied for the house income from Faroestan. That house income is now 37,000 under German law after application of the deduction method for the Sanibicia tax. So times 29,12843%. There we end up with in German law tax 52. Levied by Faroestan was 12,000. So the credit is limited to the German tax 1077. And that, ladies and gentlemen, means nothing else than the final German tax will be 2972 minus 1077. That is 10,195. Case finished and solved. And this, ladies and gentlemen, is now another case, and it's definitively the last case by which I make you unhappy for today, because then we should have a break. Taxpayer J from Geneva in Germany has a second resident in the already mentioned city of Mosul in a foreign country, where we have no double taxation treaty concluded with. He has a construction firm in Germany, and the income from a construction site in Far-Away-Stan, which lasted for 3 months, is 600,000. Income tax levied by Far-Away-Stan is 60, levied by Mosul is 50,000. Income from a construction site in Far-Away-Stan, which lasted for 4 months only, 100,000. Tax levied by Far-Away-Stan 10, by Mosul 25. And income from a construction site in Far-Away-Stan, which lasted for 10 months, 200,000. Tax by Far-Away-Stan 20, by Mosul 5,000, and special expenses of 20,000. That is the case. Nobody looks through, and we are just going to try a systematic approach and solve this case step by step, and then it will pose no difficulties. Let's make a small break and then start. Okay, here the first thing is naturally personal tax liability. J is a natural person, so ESTG applies, and it's a case for unlimited tax liability, so the worldwide income is taxable under 1.1 ESTG because of residence in the inlet. That there is a second residence somewhere else does not matter at all, irrespective of if the other second residence is a main residence or a subsidiary residence or what else. We have to deal with unlimited tax liability. That's sufficient. Event number 1 is income from business, because constructing buildings is a business activity, plus paragraph 51 number 1, part of worldwide income, paragraph 2(1) number 2, ESTG tax base, the profit, that's here given with 600,000. Treatment of the foreign taxes. Is it a case for credit method? And the answer is no. Credit is not possible because it is not foreign income, because this income from business does not come from a foreign permanent establishment of the business. The building site does not last at least for 6 months. See paragraph 12a0. So only deduction method is possible. To deduct are taxes of Far-Away-Stan plus of the city or country of Mosul. So change of income figure from 600,000 to 600,000 minus 60 minus 50, so to 490,000 euro. Event 2. Far-Away-Stan site with 4 months duration, not foreign income, same reasons as before, no permanent establishment abroad, but only a single order executed for a foreign customer, so no credit method possible. So deduction of foreign tax is mandatory under paragraph 34c3 ESTG, so income changes from 100,000 to 100,000 minus 10,000 minus 25 to 87,500. And event number 3, we have construction site 10 months. This is foreign income under paragraph 34d, number 2, letter A, because construction lasting for more than 6 months qualifies for a permanent establishment, so credit method is possible, but only for the tax from far away on itself, where the income was earned, not for the tax from Mosspool. Tax from Mosspool must be deducted then. Paragraph 34.3 ESTG. So the income changes by that deduction from 200,000 to 200,000 minus 5,000, that is 195,000. Number 3, adding it all up and calculating the tax. Well, from number 1, we have income of 490,000. From number 2, we have income of 87,500. From number 3, we have income for 195,000. Then we have personal allowances minus 20,000, and that leads us to a total of, let's compute a bit, 490,000 plus 87,500 plus 195,000 minus 20,000. That is the horrendous amount of 752,500 euro. Well, and we have now to determine the tax for that, and for that it makes sense to look to the tax activity. Yeah, as we can see here, an income which is higher than 277,000 is calculated on or is taxed on the basis of a different formula. Now 45% is taken on everything, and a correcting factor is deducted from the final result, because in reality not everything is really taxed with 45%. The first brackets of the income are cheaper, so that is why that correcting factor of 17,602.28 is deducted, and this tariff formula is what we need to deduct to compute the tax here. So we have a total of 752,500 euro. This is to be taxed with the formula which applies for income, highest income in Germany, 45% on everything minus a correcting factor, because not the first brackets of the income are taxed with a lower amount. And this correcting factor is 17,602 in the version for 2022. That leads to a tax of 321,022. And as you already have seen several times, it's always interesting to compute the average tax rate out of that. So 321,000 in relation to 752,500. If we then apply the credit method, we only have one event which is creditable. The income from far away is done, 195,000. You remember that due to the deduction of the Mosspool tax, that was going down to 195,000. The credit limit for this is 42% on that amount. That is 83,188. And this is now to be compared with the amount paid in far away on 20,000. The credit is the lower of the two, so only what was paid can be credited, 20,000. And that brings us to the final tax to be paid in Germany under the tariff 321,022 minus the credit, so remaining taxable tax to be paid 301,022, and that is already the final solution of that tax case. So this was rather a brutal video today. I'm sorry, or at least I pretend to be sorry that I tortured you so much with so many examples. I hope that you tried to follow the logic of all the examples, and it might be a good idea to repeat it from time to time or to watch the video again in small pieces, part by part. Okay, the next video will be on the next method for the avoidance of double taxation, that is the exemption method. But till that video comes, enjoy a small little break again. Thanks for watching. Goodbye till the next time. Do not forget to click the like button if you like this video, which I can't imagine. Recommend this channel to others if you like the video, and if you didn't like it, recommend the channel to persons whom you don't like. And if this video has been recommended to you, then think about out of which motive that has happened. Thank you very much, and see you again soon on this channel.